Hey everyone, it's Imran from Options Insight with your macro options spotlight for the day.
Remember, like, subscribe, comment, ask questions, do whatever you like, but we want to get the algorithm passing this around so people can learn about options and learn this information.
US stocks recovering pretty decently after a weak open yesterday, as there was some anticipation that Powell might come out a bit hawkish in his speech, but he didn't really give any love to the bears, and now focus shifts over to the CPI on Thursday. China continued to rally. Europe also still pretty well bid. It took a breather yesterday, but it's up again today. And really seems to be catching on to that China reopening narrative and outperforming pretty massively against the US. In commodities, metals keep going higher, this time led by copper. That's up 8% on the week, and it's got uranium up about 9% as well on the week. So those are your leaders there. Gold miners also doing pretty well. Gold itself starting to find a bit of resistance up here, as we mentioned in yesterday's note. And then nat gas absolutely collapsing. Had a 10% bounce from that $3.50 level, popped its head back up to around 390, and now is straight back down there again. So continuing on from that weakness that we've seen over the last month. If we look over at what's happening in other spot, the dollar stabilizing near the local lows ahead of CPI. We may get a break below that 102 level on DXY, which is a big level. So we need to watch that, see what CPI does. But the dollar's kind of at risk there of a bit of a breakdown. Bonds did pull back a bit as the curve starts to re-steepen slightly. 2s10s back to negative 65. And then ARK putting in some positive performance, continuing from that strong rebound that it saw. Those crypto stocks really leading the charge there, up again. So ARK up another 2.5% on the day, making that 10 and a bit % on the week. And then finally within sectors, commodity sectors, XME really looks like it's breaking out, up another 2.5% after about a 5 or 6% rally the day before. It's now at 54, and it's kind of leaving XLE in its dust as metals kind of re-rate on this China stimulus story. Okay, only other things to really call out on the summary is US vols getting whacked down about a point. VIX trying to attack that 20 level again, which I suspect will get broken after CPI and as we head into earnings, because all the focus is going to be on micro stories and the macro is going to take a back seat into the end of the month, when really it's the FOMC meeting on the 1st of February that's going to be the macro story again. So don't be surprised to see an 18 handle on the VIX as we go into earnings season. Other than that, VIX calls looking quite cheap. You see the skew here, 99th percentile. So that means generally it's always call skew for VIX, because that's where the crash happens when VIX goes higher. But this call skew is about as low as we've seen it at around 17 vols. So no one really reaching for upside in VIX. As we mentioned yesterday, no one really needs crash protection, right? Everyone needs protection to the upside in markets, which is then to the downside in things like VIX. That's what we're kind of seeing. And then last thing I'd call out on the summary is the FX carry, all pretty red, pretty negative, basically saying that FX pairs are moving around. I think that's going to continue. I think there's a lot of macro cross currents right now with what's going on with the rates expectations from the Fed, with all the volatility in the front end about growth data and inflation data. Are they going to do what the market thinks or not? European core inflation making the ECB stay hawkish, and then the whole China reopening narrative providing a global reflation impulse. We don't know how long and how far-reaching that's going to be, but that's certainly how these reflation assets are trading. So I think all those things are going to keep FX rates moving around, and in those single-digit vols, they don't look ridiculously expensive. Okay, moving on to the topical stuff. So CPI print on Thursday is going to be your major catalyst for this week, macro-wise. Powell did little to counter this kind of current market dynamic that suggests that a recession leads to disinflation, which leads to a pivot. Now, last month's CPI data print, obviously, that came in light, was closely followed by a FOMC meeting. So investors didn't really, that bid that you saw in the market from the algos got absolutely faded, because everyone knew that Powell was speaking in the next day, and there's no way that he's not going to come out marginally hawkish after that number. So the market didn't stay high. This time round, we don't have the Fed speaking so soon, but what we have is bank earnings kicking off on Friday, which are kind of perceived to be more positive than consensus estimates, right? I think the whisper is that the banks are going to have an okay quarter. That's certainly what I'm hearing. So that may well be, if you were to get a light CPI, and the CPI fixings market, which has done a good job of predicting these prints recently, is expecting a downside surprise. If you were to get that, and you have anticipation of decent bank earnings the next day, and then you get a confirmation of those decent earnings, then markets could be off to the races again. Another key factor in determining what markets are going to do is what happens in the zero DTE option space, right? That is still dominating things. This chart here shows you the color coding, right? The zero DTE options on Monday across all of the local strikes far dominated any activity in even the one-day options or any other options across the surface. So they are very much what it's all about. On non-farms last Friday, those zero DTE calls from the 38.90 to the 3900 strike, in those 3 different strikes up to there, they accounted for 60% of the call volume, right? And that helped fuel the rip higher into the close as dealers scrambled to cover the growing delta exposure that you get as you move into those short dated options and through those strikes. So I think we could easily see another bout of intraday vol catalyzed by similar flows tomorrow if the CPI gives market players a reason to get involved with the zero DTE again, and we do get a miss from expectations. So look out for that. Okay, so now let's talk about China, because that seems to be the big thing on everyone's minds. How much legs is this China rally going to have? Is this going to be the dominant theme that drives a bit of a reflation type move in the early part of this year? Now we're seeing other assets like Aussie dollar, DAX, because of the exporting, metals, all really starting to join the party. But Chinese stocks are up about 50% from their lows around Halloween last year. Now, we've owned some Hong Kong calls in the portfolio since October. So we have participated in this move, not in monster size, unfortunately, because it was a bit of we weren't so sure it was going to work because the initial sort of reaction to the Congress wasn't very good. But, we thought the vol was cheap enough to participate in those Hong Kong options. So we did own those. But now we think that there could well be some more medium-term upside. So we do think this thing's a bit overbought in the short term. You see the RSI up here at around 70. And we have had that 50% bounce off the lows. So I wouldn't be surprised to see some consolidation here before the next leg higher. I think that next leg higher probably does come because I think a large amount of money managers, EM money managers specifically, would have looked at China as uninvestable last year. And now they're starting to think, actually, we kind of have to be in China, because if that's the thing that's going to drive EM performance this year and we miss it, we've got a problem, right? So I do think there'll be allocation back towards China, and we're probably already starting to see some of that. And that's why we're rallying so strongly. Now, in the short term, we may consolidate. So that's what you need to bear in mind. Things are overbought in the short term, but you probably do still want to have some upside on the book for this China rally and for this reopening trade. Okay, so how do we do it? So I obviously analyze the surface quite closely. We have seen spot up, vol up behavior in China. So this skew scatter diagram shows us that, and this is for the 3-month volatility, right? So when you had that initial move down from China into the Congress, you had a pretty strong spot vol correlation here, right? So the color coding shows 3 months ago, 2 months ago are the red and the yellow. As we moved down in spot, we moved up in vol. That's your typical equity correlation between spot and vol that you normally get. Now, since we've bounced and we've rallied all the way back up here, what has vol done? You can see the last 2 months, which are the green and the blue, have got a much shallower slope. So what we're seeing is in the rip higher that we've seen, vols are not collapsing back down. They're actually performing pretty well. So implied volatility is holding up on the rally. So that's an encouraging thing if you're going to be a buyer of upside options, because the volatility isn't collapsing as we rally. But then you've got to zoom out a bit and you've got to look at where vol is in its longer term context. And you can see here, I've got a couple of metrics. I've got the 6-month 10 delta calls. I've got the 3-month 25 delta calls. And going back like 4 odd years, this stuff has traded as low as 15 vol. And right now it's at around 30 vol. So it's about double the implied vol that it can get to. I'm not saying it's going to go back to 15, but you just want to be aware of how expensive this vol potentially is before you suddenly jump into buying a load of outright call options. Okay. Then we look at our trusty vol dashboard. What do we see? We've got Obviously, it's looking overbought, right? So this is saying to sell calls, do bearish risk reversals, things like that. That's not a trade. I'm not really looking to fade China right now, but I need to factor in that things are overbought. So I don't want to pile into a load of, high delta call options when things are looking so overbought in the short term. Okay, so that is telling me be careful about how much delta you buy. Now, what else is this telling me? It's telling me that the longer dated part of the curve has started to shift down, but the curve is still inverted. So you see this front end volatility trading above the back end volatility. There is still an inversion in the curve. So there may be some opportunity in doing some term structure trades where you sell the front and buy the back when the curve is still inverted. So that brings me on to my trade idea of how you can participate in China in what I believe to be the most efficient and probably the safest way, given how overbought things are right now. All right, guys, that's it for today. Thanks a lot. I'll catch you tomorrow.